gold's value has surged by more than 40% this year, driven largely by central bank purchases and strong demand from Chinese investors. Analysts at Goldman Sachs suggest this momentum reflects a growing shift towards safe haven assets amid global uncertainty. Meanwhile, the Commodity Channel Index, or CCI, has climbed sharply to 130, signaling strong market momentum and potential overbought conditions. Traders are watching closely for any signs of reversal as bullish sentiment continues.
Sorry, Alice. The reporter's talking about the CCI indicator. What exactly is CCI? Could you please explain it to me?
Yes, Ben, of course. I can ask Marta to join us and explain it better.
I'm glad to join you all today and share a bit about one of the most practical momentum indicators in trading, the Commodity Channel Index, or CCI. Markets often swing between periods of being overbought, prices rising too far, too fast, and oversold, prices falling too much. Traders need tools to identify these extremes to time entries and exits more effectively. The Commodity Channel Index, CCI, developed by Donald Lambert in 1980, is designed for this purpose. It measures how far price deviates from its statistical average, helping traders spot potential turning points.
Thanks. What's the definition of CCI, and how can we actually use it in trading?
Great discussion, Marta, and thanks for the explanation. And nice question, Raphael. Well, to summarize, the Commodity Channel Index, or CCI, is a momentum-based oscillator. It measures how far an asset's price moves away from its average over a chosen period, usually 20 days. When the CCI value is high, above plus 100, it suggests the asset might be overbought. When it's low, below minus 100, it indicates the asset could be oversold. Unlike the ATR, which only measures volatility, the CCI helps identify potential trend reversals or continuations. In simple terms, it shows how strong or weak the current price movement is compared to normal. Traders use it on all kinds of assets, not just commodities, to time their entries and exits and to confirm momentum.
Thanks, Marta. But how can we actually calculate the CCI? Is it too complex?
No, it's not complex. The formula for the Commodity Channel Index, or CCI, is quite straightforward. You take the typical price, subtract the simple moving average, and then divide that by 0.015 times the mean deviation. The typical price is simply the average of the high, low, and closing prices. That's high plus low plus close divided by 3. The simple moving average, or SMA, is the average of those typical prices over a certain number of periods, usually 20. The mean deviation tells us how far each typical price is from that moving average on average. And finally, the constant 0.015 just keeps most CCI values between plus 100 and minus 100.
So it's a very practical indicator then. What are the strengths and weaknesses of this indicator?
Good question, Ben. Let's start with the strengths. First, the CCI is very versatile. It works across different markets, stocks, forex, commodities, even crypto. Second, it's great at detecting extremes, helping traders spot when prices are overbought or oversold. And third, it captures trend and momentum effectively, especially when it's combined with price action. But like any indicator, it has its weaknesses. In choppy markets, the CCI can produce false signals, those quick whipsaws that confuse traders. It's also sensitive to parameters, meaning the results can change depending on the period length you choose. That's why most professionals use it together with other indicators, like RSI or MACD, to confirm signals.
Okay, Marta, but how can we actually use it? Is there any real scenario you can show us to explain how it works?
Sure, let's take a simple example. When a stock's CCI rises above plus 100, it shows strong upward momentum and possible overbought conditions. In that case, a trader might prepare for a short entry if the price action starts to weaken. Conversely, when the CCI drops below minus 100, it signals that the market may be oversold, and buyers could start stepping in.
Good point, Marta. Let me add another example. Imagine the market is in a strong uptrend. The the CCI pulls back towards zero, but stays above plus 100. That tells us the trend is still strong. In this case, it's not a signal to exit. Instead, it's an opportunity to add to your position or hold your trades, since the pullback is temporary and the overall trend remains intact. By the way, if you'd like to dive deeper into all of this, I really recommend this book, Algorithmic Trading Strategies. It covers everything we talked about today in much more detail, including real trading scenarios, strategy design, and even example code. It's a great resource if you want to understand how indicators like CCI fit into full algorithmic systems.
Thanks, Marta. Your explanations really made the CCI much clearer.
And thank you, Alice. That example and the book recommendation were really helpful.